Today is Sunday, 15th February 2026. Gold, silver, platinum, and palladium. I'll examine what's happened over the day, set those moves in a wider and longer-term context, and close with a structured assessment of where the markets stand this evening and what traders will be watching in the next session. Let's start with the main driver across precious metals in the past day. It's been a repricing after fresh US inflation data. According to the Wall Street Journal, the US Consumer Price Index, or CPI, cooled in January to 2.4% year-on-year. The same report put the monthly rise at 0.2% core inflation, which strips out some of the more volatile items, was described as 2.5% year-on-year, with a monthly core reading of 0.3%. That matters for metals because inflation data feeds straight into expectations for US interest rates. When markets think policy rates may be lower in future, the yield on government bonds often falls. And when yields fall, the opportunity cost of holding non-yielding assets, like gold, tends to look lower. That's the basic channel. It doesn't guarantee a move on any given day, but it helps explain why gold and silver reacted so sharply to this particular CPI print. We also saw that in the bond market. Barron's described a clear drop in US Treasury yields after the CPI release, with both the 2-year and 10-year yields down by around 5 basis points on the day. That's a small sounding number, but in rates markets it can be meaningful, especially when it comes in a quick repricing after a major data release. Another market report, carried by Market Minute, put the 10-year Treasury yield around 4.06% after the data, again pointing to that same rates relief impulse. Alongside rates, the broader risk mood was mixed. Equities were broadly flat on the CPI day, but they were down over the week. That combination often produces a cautious tone. It's not a clean risk-on surge. It's more like relief in rates, with investors still watching the wider picture. Now to gold. Over the past day, gold rebounded sharply and moved back above a psychologically important level. A market report carried by the nation Thailand said spot gold jumped by more than 2% after the US inflation data, with spot prices cited around $5,030 an ounce. A separate daily series from Stat News Money showed gold closing in the low $5,040 an ounce area in mid-February, reinforcing the point that gold has pushed back above $5,000 an ounce after a volatile stretch. When we talk about a psychological level like that, we simply mean a round number that many traders watch. It can affect behavior because it's easy to remember, and it often sits near clusters of orders. It doesn't change the underlying value of the metal on its own. But it can shape the way price action looks in the short term. In this latest move, the story was largely macro-driven. The CPI reading came in softer than many expected, yields fell, and gold responded quickly. The speed of the rebound also suggests positioning and flows mattered. In plain terms, that means some investors who had reduced exposure earlier may have moved back in, and some short positions may have been covered. We can't see every position directly in real time, but the size and pace of the move, alongside the clear macro catalyst, is consistent with that kind of flow-driven rebound. It's also worth placing this in the context of the past week. Gold has not moved in a straight line. It's been a wide-range environment, with sharp downdrafts and sharp bounces. In that kind of tape, the market can feel jumpy. Small changes in expectations around inflation and interest rates can produce outsized day-to-day moves. Another point to keep in mind is the role of safe haven demand. When investors feel cautious about risk assets, gold can benefit, even if the immediate trigger is something else, like yields. MarketWatch, in a separate piece focused on hedging and risk conditions, described a risk-off backdrop in broader markets. That doesn't mean panic. It means investors are paying close attention to protection and to what might hold up if growth or risk sentiment wobbles. So, for gold today, the clean summary is this. Softer US inflation data helped pull yields lower. That improved the near-term backdrop for a non-yielding metal. Gold responded with a strong rebound, and it reclaimed a major round number level. Now to silver, which continues to trade with much higher volatility than gold. Over the past day, silver stabilized rather than trending. A market write-up from TS2.tech, referencing Kitco pricing, described silver holding near the $77 an ounce area after the CPI cooled. Stat News Money's daily series also showed silver closing around the high $70 an ounce area in mid-February after large swings in the sessions immediately before. Silver's behavior can be harder to read because it often switches roles. At times it trades like a precious metal, moving with gold on rates and safe haven demand. At other times it trades more like an industrial metal, reacting to growth expectations and risk appetite. On top of that, silver can be more sensitive to liquidity. When trading conditions are thinner, price swings can be amplified. And liquidity is a key theme into the next session. US markets are closed on Monday for President's Day. That can affect price discovery across metals, foreign exchange, and rates. It doesn't mean markets elsewhere are shut. But it can mean fewer participants, wider spreads, and sharper moves on smaller flows, particularly in instruments that normally lean on US trading hours for depth. In the last day, the CPI relief helped silver find some footing. But it hasn't ended the high volatility regime. Recent sessions have featured large intraday ranges and rapid reversals. That's important for anyone watching the broader precious metals complex, because silver swings can spill into sentiment around miners and exchange-traded products, and they can influence how traders talk about the whole space, even when gold is the steadier bellwether. So, the silver takeaway is stability for now, but with volatility still very much part of the picture. Let's move on to platinum. In the past day, there wasn't one single, widely documented spot move that stood out across the most robust sources in our brief. Instead, the clearest reporting in this window was more about the broader backdrop for platinum group metals rather than a specific day's print. For that wider context, Reuters polling from late last year, republished by Investing.com, described analysts raising their forecasts for platinum after a strong prior year rally. The same report highlighted themes that have been driving platinum sentiment, including supply tightness and uncertainty linked to tariffs. Those are medium-term factors. They don't always show up as a clean daily headline move, but they shape how the market thinks about the balance between supply and demand. Platinum is used in industrial applications, including auto catalysts, as well as in jewelry and investment. That mix means it can respond to both macro forces, like the US dollar and global yields, and to more specific industry factors, like vehicle production trends and substitution between metals. In the last day, the macro spillover from the CPI repricing is still relevant. If yields fall and the US dollar softens, that can be supportive for dollar-priced commodities in general. But without a clear, consistently reported spot move in the top-tier sources for this specific window, it's more responsible to frame platinum today as part of the broader precious metals response to rates, rather than claiming a precise day move. Now to palladium, which sits in the same family of platinum group metals and shares some similar drivers, while also having its own demand profile. As with platinum, there wasn't a single dominant, consistently documented last day spot move across the strongest sources in this run. The more solid material was again about the broader tone. Reuters polling, again carried by Investing.com, described palladium's prior year performance and pointed to tariff and geopolitical uncertainty as key themes. Palladium's supply chain has long been sensitive to geopolitical risk, and market commentary often focuses on how policy and trade measures could affect flows and availability. For a spot reference point in the recent period, macro trends showed palladium around the mid-$1,000 US and cents an ounce area in mid-February. That's not a day move. It's a level reference. It helps anchor where the market has been trading, but it doesn't tell us what happened minute by minute in the last session. So, for palladium today, the clean message is that the macro backdrop still matters, but the dominant narrative in the most credible reporting is about ongoing uncertainty themes rather than a single day's price swing. Let's now pull the macro threads together, because they explain the common movement across the complex. First, inflation. The US CPI reading of 2.4% year-on-year, as reported across outlets including the Wall Street Journal and others, was the key catalyst. It reinforced the idea that inflation pressures are cooler than they were, and it shifted expectations around the path of US interest rates. Second, yields. Barron's reported that Treasury yields fell, with the 2-year and 10-year down around 5 basis points on the day. That matters because yields are a direct competitor to gold. If you can earn more in safe government bonds, gold can look less attractive. If those yields fall, gold can look more attractive, all else equal. Third, the US dollar. In many market episodes, a fall in yields is associated with a softer dollar. A softer dollar can make dollar-priced commodities cheaper for buyers using other currencies, which can support demand at the margin. In this specific window, we don't have a single top-tier source giving a precise dollar index level in the last day. So we'll keep it to the general relationship rather than quoting a number. Fourth, risk sentiment. Equities were broadly flat on the CPI day, but down over the week, as described by Barron's. That's consistent with a cautious undertone. In that environment, gold can benefit from safe haven interest, while silver can be pulled in both directions, depending on whether the market is focusing more on rate relief or on growth concerns. Now, a structured assessment of where markets stand this evening based on what we can say from the sourced facts. For gold, the market is responding primarily to rates and inflation expectations. The CPI surprise was the immediate trigger. The yield move supported the rebound. The price action shows gold back above $5,000 and cents an ounce, with reported prints around the low $5,030s and cents an ounce in spot commentary, and closes in the low $5,040s and cents an ounce area in a daily series. The wider context is that gold remains in a strong regime, but with unusually wide daily ranges in this part of February. For silver, the market is stabilizing after extreme volatility. The CPI-driven rates relief helped it hold around the high $70 and cents an ounce area, according to the cited market commentary and daily series. But the defining feature remains volatility, with sharp swings and quick reversals still fresh in traders' minds. For platinum and palladium, the most robust material in this window is about broader drivers rather than a single day's move. The macro impulse from CPI and yield still matters, but the medium-term themes being discussed in analyst commentary include supply tightness and uncertainty around tariffs and geopolitics. Those themes can influence sentiment even on days when spot moves are not the main story. Now, the close and overnight look ahead focused on what traders will be watching in the next session without making any predictions. The first watch point is liquidity. With US markets closed for President's Day on Monday, trading conditions can be thinner. That can affect how smoothly prices move, and it can increase the chance of sharper swings, especially in silver. The second watch point is the next set of US data that markets have flagged. Commentary in the market coverage has pointed to personal consumption expenditures inflation, often called PCE inflation, and durable goods data in the week ahead. PCE inflation is watched closely because it's a key inflation gauge for the US Federal Reserve. Durable goods data can shape views on demand and investment in the economy. Traders will be watching those releases because they can feed back into the same chain we saw today, from inflation expectations to yields, and then into precious metals. The third watch point is the bond market itself. After a meaningful move lower in yields, traders will be watching whether that move holds and whether the curve, meaning the spread between shorter and longer dated yields, continues to shift. Again, we're not forecasting direction. We're simply stating what matters, because gold and silver have been highly sensitive to these rates moves. The fourth watch point is broader risk tone. With equities having been flat on the CPI day but weaker over the week, investors will be watching whether caution persists. That can influence gold through safe haven demand, and it can influence silver through its risk-sensitive side. Before we finish, let's recap what mattered today and why. The key event was softer US inflation data. The US Consumer Price Index cooled to 2.4% year-on-year in January, as reported by major news outlets. That shifted expectations around US interest rates. Treasury yields fell, with market coverage citing declines of around 5 basis points in key maturities. That rates relief improved the near-term backdrop for non-yielding metals. Gold responded with a sharp rebound, moving back above $5,000 and cents an ounce, with spot commentary citing levels around the low $5,030s and cents an ounce. Silver held around the high $70 and cents an ounce area, stabilizing after extreme volatility, but without losing that high swing character. For platinum and palladium, the clearest source narrative in this window was about broader supply and policy uncertainty themes, rather than a single day spot move. So, you're now up to date with what moved today, what mattered, and why it mattered. That's all for this evening's Global Precious Metals Update from Wessexmint News. Thank you for joining me. If you found this useful, please follow or subscribe on whichever platform you're watching. I'll be back again tomorrow. For now, from all of us here at